Coming up on this episode.
What types of insurance products do we have in this market?
We have the protection policies, which are just purely risk management. We have the savings policies. We also have the investment-linked type products.
Why would it be that you would receive less than what you put in, and is that in all instances?
Yes, there have been those challenges in the market.
What would somebody who feels dissatisfied with their policy do without losing out?
You must remember that insurance has the component of protection as well.
Right.
So it is not straightforward that you will get everything that you have.
Hello ladies and gentlemen, you are watching the ICIFA Investment Show, where we showcase different investment products, opportunities, and where you can access them. We speak to professionals and experts in the industry on these different ones. My name is Rina Hicks. I'm the Operations Director at FA Investment Bank, and I'll be your host today. Today we're talking about insurance, that big word, insurance. A lot of people have had all kinds of experiences where insurance is concerned. Our focus, however, is on life type insurance products, not general insurance like your car insurance or your house insurance. We're not looking at that. We're looking specifically at life and life related insurance products. How do you access them, and what are they, and how do they work? And I have with me FA Abed Mureithi. Abed is the principal, he's the MD and principal actuary at ACTSERV, an actuarial consultancy firm, and he's here with us. Karibu sana, Abed, and thank you for making the time.
Thank you.
Yeah, so before we get into it, please let us know a little bit about what you do, what does ACTSERV do,
Yes.
and what is actuarial sciences.
Okay. Thank you very much, Rina. My name is Abed Mureithi. I'm a qualified actuary by profession, a fellow of the Institute of Actuaries in the UK. I'm also an FA of ICIFA. I think one of the initial lot that got our FA qualification. In our firm, my experience has been in both pension consulting and insurance consulting, and also touching on the investments. As you know, these are funds. Both pensions and insurance hold significant funds, and so we also advise in terms of investments. My experience has been in Kenya and also in the region, South Africa, Central Africa, and Eastern Africa, and we do quite a lot of investment advisory work, and typically helping funds set the investment strategies, in addition, of course, to advising on their products that they are offering to the general public. And then that's just a brief rundown of who I am.
Okay, so not just within the insurance sector, it's generally kinds of investment products and opportunities they're looking at.
Specifically in pensions, and in insurance, because that's why we have very legislation requires actuarial involvement even in the investment side. Yes, definitely, okay. Yes.
Okay, awesome. So perhaps we can begin by talking about the types of insurance, because it gets a bit confusing when people are wondering, is insurance an investment? Is it a risk management tool? I mean, what makes it, a savings or not? And so there's just a bit of haziness where insurance is concerned, and I'd like us to provide clarity. So let's start with the types. What types of insurance products do we have in this market?
Okay, so on the life side, we can categorize them into three types.
Okay.
We have the protection policies, which are just purely risk management. We have the savings policies, which have a return of either the premium or have a maturity benefit in case one survives to the very end. And we also have the investment-linked type products, which try to match the performance of a certain investment asset or group of assets in the typical insurance space. In terms of just the protection products, this one, for example, a funeral cover. This one offers a benefit in the event of the passing on of the policyholder, and it's paid, of course, to the beneficiaries, and typically used to cover the expenses associated with, the funeral arrangements and the like. We also have what are usually the term type products, which offer, in the event of death of a given period, during a given period, there is also a benefit payable to the beneficiaries. They may have higher sum assureds than a funeral cover. And then we have various other protection products, the group lives that one would have in their companies, and the like. The savings products are a lot what are sold by sales agents to individuals. Some of the typical ones would be like your education policies, which pay out at maturity. So it may be a policy that is maybe 12 years. And the benefit if at maturity at the end of the 12 years is paid over, say, a 4-year period.
Okay.
And that would maybe then cover the school fees of maybe a dependent over their 4 years, maybe in high school, say, for example. And what would happen, they would also be coupled with the protection. So in the event of the parent passing on, before even the maturity, you still find that the maturity benefit is still paid. The school fees will still be paid even at the end, even if the parent passes on, even within the second or third year of the policy. And then you have the investment type products, investment linked insurance product. They would also, what they have is the benefit is paid as the accumulation of the premiums, or a proportion of the premiums, together with whatever investment returns have been generated.
So whatever you're paying into the policy, that premium accumulates?
Yes.
And is there an investment element that adds to that?
Yes, they then would add investment. So, but in that sense, there is no guarantee in terms of how much the benefit will be, as opposed to the typical savings product where they have already predefined how much you will have at the end of the period. So the unit-linked or investment-linked type of insurance product would have a variable component because of the investment return component that can fluctuate from year to year. So those are just the typical kind of products that are there out for life cover.
Okay. I want to go back to the endowment type savings product you talked about.
Yes.
So it's predefined what you will get, but the premiums are being used and being invested by the insurance company. Yes. Are you saying that they don't pay any of that to the beneficiary?
Okay, what happens is typically what an insurance company will do is, and it's good you've said about the endowment type products. There is also a variable component that usually comes with it. They call them bonuses.
Okay.
So you'll have your predefined benefit, which is guaranteed.
Right.
And then every year they will do a bonus declaration saying that to your benefit, we will add a certain amount. It might be 2.5% of that sum assured. And what would happen is when premiums are received by the insurance company, of course, it will first take off its expenses. It will then look at what has been its investment return. And then it will then be able to say there will be a distribution of bonus out of the excess funds now that it has received. That is out of a combination of the premiums minus expenses and then plus investment return.
Okay.
And then they will, of course, also the insurer will take a profit share out of it. They also have to make profit at the end of the day. So, but of course, everything is in a pooled fund. It's pooled, so they have more muscle, of course, when they're going to invest and that kind of thing. And what they would typically do every year, they'll declare the bonus. Once the bonus is declared, it becomes a guaranteed part of the benefit. But before that, it's just a discretionary. It's at the discretion of the company whether they will declare a bonus. But at the beginning of the policy, there is always that basic sum assured that is guaranteed.
Right.
Whether investment comes right or wrong, whether the company is not able to manage its expenses well enough or not, it will always be guaranteed as a basic sum assured. And then every other year, as bonuses are declared, they now become also guaranteed as they are declared, but that is at their discretion. The amount that is declared is at the discretion of the insurance company.
Okay. So as you're describing that, I remember having a conversation with somebody not too long ago who said to me that they had invested in one of those savings products.
Yeah.
And they were a little frustrated because they had put in a certain amount of money. I think they were investing 5,000 to 10,000 shillings every month. And when they did the math, they found the amount that they were going to receive back was actually less than how much they had put in. And they were wondering, what do I do? Do I stop paying into this thing? What do I do and how do I handle it? So maybe we can take a two-part sort of question. One is, why would it be that you would receive less than what you put in? And is that in all instances? And then the second question is, what would somebody who feels dissatisfied with their policy do without losing out? But let's start with the first one.
Okay, so the first one is, does it happen that at times people pay in more than they will eventually receive if they survive to the end of the policy? Yes, there have been those challenges in the market. Of recent, there are a number of companies that have tried to address that by ensuring that there is value to what somebody has put in. But you must remember that insurance has the component of protection as well.
Right.
So it is not straightforward that you will get everything that you have received. There will be part of it that is going to cover the risk element of maybe some of the policyholders not surviving to the end of the term, and benefits will still have to be paid. So there's that aspect of protection. But in terms of how do you address, of course, it's about getting the right financial advice. Of course, a sales agent is very conflicted because they are working for the interests of the company. But once you get the right kind of independent financial advice, you can also be able to tell which products are better than others and which one meets your actual needs. Because at times, what we really need is a protection policy for our needs. Once one does a needs assessment, and so then you do not get that problem of you have paid more than you're expecting to receive, because you know that whatever you're paying in is purely for protection. And at times we need savings products that provide both a component of protection and a component of savings. But it really depends on the kind of financial advice you receive. It's been a concern in the industry that people are not getting value for money. There were challenges, especially when initially unit-linked products were introduced. The expectations of policyholders was very different from what had actually been communicated. And we know that some companies actually withdrew the products, those type of products, because of those challenges about communication. But at the end of the day, one should just be able to take the necessary financial advice. Typically, it's best, at least some level of independence in that advice, so that one can be able to get the right product which gives you the right value. And we're happy to say, yes, insurance have really innovated and have come up with even now we can see there's quite a bit of unique products in the market that really, at the end of the day, when you analyze them, they're really offering value for money. But sometime historically, there have been challenges that have been there in the industry.
Okay.
Yes.
So if somebody finds themselves in a situation where they want to pull out, what happens? I am aware that you have to sort of have been invested for 3 years or thereabouts. Otherwise, then you don't get anything. But what would your advice be?
There at times there's some clauses that can be very restrictive. There is a typical 3 years. We know that there are a few insurers who have reduced that to 2 years.
Okay.
It would be great to have insurers moving to 0 years. But there is a period when it is very restrictive, and yes, it's difficult to pull out. But after that, one is able to get what are called surrender values. You surrender your policy. If you feel it's no longer meeting your needs, you can surrender. Yes, there will be some penalties and cost implications to surrendering, but it's a way to just get out of maybe something that is not exactly meeting your needs. There are also the ability to take policyholder loans against your policy value.
Okay.
If you still feel you want to continue with the policy. and that could also be another way to partially access your policy. There have been conversations in the industry on how to convert from one policy type to another policy type, and there are actually insurers who have offered that, especially when a product is found to be really not the best for policy holders, and it's causing maybe some reputational challenges. So there do come those offerings of an exchange in terms from one policy type to another policy type. So those are maybe some of the solutions that are there. Yeah.
That's helpful. In terms of the independent financial advice where insurance products are concerned, somebody that you can sit with and sort of share your personal circumstances, and then they're able to tell you you're better off with this as opposed to this other one. Where can one get that kind of help from?
Okay, generally quite a number of insurers, yes, it's about the experience. A lot of sales agents have actually become financial advisors, but it has not become a mainstream way of doing things.
Okay.
And perhaps this could be a positioning for members of ICIFA, but if they can become independent financial advisors. It's quite entrenched in Western countries. You have, hotlines you can call just, to get your financial advice independent from maybe a typical sales agent and that kind of thing. But yes, it's definitely an area that needs to grow in the country.
Okay.
And it does provide an opportunity for those who would be interested in taking up such a role.
Yeah. What are some of the mistakes you've seen people take or making when they're taking insurance products?
Number one is not doing the needs assessment.
A needs assessment?
Yes. You really need to know why you're taking the policy and how that policy is addressing those needs. So yes, people know that they want to address an educational need, but the policy may not necessarily be addressing that. The way the policy is structured, the way the value of the policy to the individual is, they're not able to see how that is addressing their need. That's why you find the issues of somebody saying, I've paid too much, I've paid more premium compared to the benefits I'm expected to receive.
Right.
You really need to do that needs assessment. Know what is it that you really, really require. Some who are sophisticated investment professionals may find that they actually don't need an insurance product with any savings component, because their investment needs may be addressed by an investment product.
Right.
But their protection needs, they probably still need to utilize and to take up an insurance product. So those are maybe, that could be one challenge. Another challenge is people not being able to shop around enough. Yes, you're relying on an agent who is perhaps only tied to one insurance company. So you find that he will only give you the products that are offered by that insurance company and on the terms offered by that company. But if one does shopping around, you might find that there could be a better benefit, similar, so same benefits, but maybe at a more affordable cost or more value for money from a different insurance company. Another thing is, of course, the general education about insurance products. You find that it's quite limited. If you go to countries like South Africa and the like, the typical mindset is once you're starting your job and everything, you need to have your life insurance policy in place. It's not.
Oh, even without dependents?
Yes, even without dependents, you already know that this is part of, it's almost a culture thing for a lot. But here in Kenya, we still are lacking in the education. It's interesting. For example, funeral products are very large in South Africa. It's a very big business in South Africa. But you find here in Kenya, everyone still wants to do, still focused on the harambees and, but yet, it could be addressed significantly by just having funeral products readily available. Perhaps also another area is just the channels of distribution of products. You find that sales agents target a lot of people who are in the formal sector, who are receiving that annual, that monthly paycheck. But even when you look at it, they say that Kenya's formal population is about 3 million, formal employment, and informal is almost 15 million. You see, there's a whole target market that has not been considered by a lot of the insurance companies. So maybe they also don't have access to the knowledge about these insurance products that could actually be able to meet their needs.
Okay. Wow. What are some of the questions somebody should ask? I guess you talked about the needs assessment. But when you're sitting with an agent and perhaps you have not had an opportunity to find an independent financial advisor, what are some of the questions somebody should ask an insurance agent so that they determine whether or not a certain policy works for them?
The first question is, what is this? What are the benefits?
Okay.
And what are the events that lead to the benefits being paid?
Okay.
So you need to know, does that address then your needs? The second thing, does it come at an affordable cost? What are the total premiums I will have paid compared to
the cost?
Compared to the benefits that you will actually receive?
Okay, the total premiums I will pay compared to the benefit that will come through.
That question you must always ask. Number three, if you're a bit more sophisticated, definitely, what is the comparative with other products?
Right.
And you would need to think widely, not just restrict yourself to insurance and say, what about also investment products? What is the comparative? At times it may be worth it to split your products. Instead of taking one policy, you might find by splitting the product, you find that there's more value that you get. You pick two products instead of one product.
Can you give an example?
Yeah, for example, you might want an endowment product. So it has both the protection or the risk management benefits, but it also has a savings component. But you may not be able to see the true cost to yourself because they are combined. But you can actually split it into a product for protection and maybe have a term product, because a term product only pays in the event of death. So there's no savings component to it. And then now you pick maybe a unit-linked product that has an investment component to it. And then when you compare what you're going to be paying on those two products compared to this one product, you might find it's better value to have two products. But that requires a bit more sophistication, definitely, to be able to do that kind of comparison. But where there is comparison, of course, you'd be expected to get better value for your money.
Okay.
Yes.
So you've talked about term insurance.
Yes.
I want you to help us understand the difference between term and whole life.
And whole life.
Yeah.
So a term gives you cover for a specified period of time.
Okay.
So you might say, in the event of death over the next 10 years, there'll be a benefit paid maybe of 500,000, as long as you're paying your monthly premiums. A whole life, however,
but you've said within 10 years. So if I live beyond the 10 years, what happens?
The cover will have lapsed.
I see.
Yes, the cover will have lapsed. So there'll be no more coverage after the 10th year.
Right.
But a whole of life, it gives you cover for?
Until you die.
Until death.
So you don't specify the number of years?
You don't specify the number of years. What may be specified in the contract is the period that you will pay premiums. So you might start paying premiums, say maybe you are 30 years. You pay from 30 to 60 years. So you only have a premium paying term of 30 years. But the benefit will be available from the time you start at 30 years. So in the event of death, even if you reach 100, the benefit will still be paid at 100. So the benefit period will cover your entire life from the time that you start. Maybe also another important thing to note is that it's far better to start policies when you're younger because the rates are much lower.
Okay.
So you find that somebody who is maybe 50 years and is taking up a policy will fall into a lot of challenges of trying to find value for their money. But somebody who starts at 18 years, the premiums may be very, very low compared to the expected payouts that would eventually
I see. And so that's why you are saying when people in other Western countries or even in South Africa, when they start working, they get an insurance policy.
Yes.
Not because they need it then,
yes,
but it's actually cheaper to get it then.
It's cheaper. It's a financial planning tool. Yeah, it's not just a risk management tool, it's also a financial planning tool. Yes. And
okay. So where can you access whole life in Kenya?
Yes, you can access whole life in Kenya. There are companies that are now offering it.
Okay.
But it does have quite good value for money. And one thing about whole life, it can also be viewed as an inheritance product because you can take quite a significant sum assured of coverage, even 10 million shillings of coverage, and upon one's passing on, that benefit just goes to your child beneficiaries, and it's a form of just wealth transfer as well, estate planning actually. One would say those are just some of the ways to think about the insurance policies.
Yeah. So we have lots of young people who are watching this, in their 20s and 30s. What advice or parting shot would you have for people in that space, in that season of their lives, hearing about insurance and thinking it's for their grandparents? Just what would you have to say to them? Problem deferred will still be a problem. It's important to understand how does insurance assist you financially? How does it assist your future dependents financially? So it's far better to address your problems earlier than to wait to deal with them later. Unfortunately, I don't know what happens to all of us. We always want to deal with our problems when we are much older. But taking the decisions to to get the right financial products, the right insurance products at an early age will help you a lot. At the later years, you will not have the stresses and the challenges that others will be going through in their later years by just starting early. It's the same as investment. We're told start investing early. People who try to start investing when they're 60, they typically will have a shorter investment period and may not be able to meet the final investment goals just because of the timelines. It's the same also with insurance. As a young person, it's far better to start early at the lower premium rates and still be able to get the same benefits that one would have still gotten even if they started paying the premiums much later. Yes. Thank you so much. I heard somebody once say that every person you will ever meet knows something that you don't. And for sure, this experience has been very enlightening. I always looked at insurance products as a risk management tool, and that's it. But to hear you talk about the fact that it gets more expensive, more difficult, from a value perspective later on, and you should start as early as possible, is not something I even had in my mind. And so I'm happy for those who are listening now, who can make that decision to start now, figure out what works for them. I thank you so much, Abel, for taking the time to come and share this valuable information with us. Ladies and gentlemen, we have come to the end of today's show. We've been talking about insurance and the different insurance products that exist, the importance of starting early and planning your finances where insurance is concerned. So if you have any questions, feel free to email us, info@icifa.co.ke. Subscribe to this channel, and guess what? This is our final show for this season. We've had several other shows. I encourage you to go back and watch them. We shall have season 2 starting soon, and it will be bigger and better. And so make sure you subscribe, share these videos so that others can also benefit from this information. God bless you guys and have a wonderful day. Bye-bye.